So what is the market about? These are my honest views on what the market is about. On the back end, all it is a bunch of candles with measurements and numbers. Now if we have a close look at this chart, you can see where I've drawn a trend line from the beginning of the chart to the first actual resistance, carried on through the second resistance and third resistance. We can see the parabolic advance, the drop down, and the respect of the trend line. Most traders started spot buying Bitcoin around about here, the ones that knew what was happening, all simply because of this one trend line. And other factors as well, where volume kicked in and so forth. Now, the market is designed for your failure. The system is constructed so well just to make you lose. Now 90% of traders lose 90% of their money in the first 90 days. You're conditioned and incentivized to hodl. They want you to hold as long as they can make you hold. 80% of traders only go long, meaning they anticipate the price of the market to go up. Now trading is a two-way street. It goes up, it goes down, and we have the opportunity to win regardless which way it goes. We can anticipate the short and expect the price to go down and pocket the profits as the market is going down. Now if you look at the charts, you will see that the long period, the parabolic advance of a chart, doesn't last as long as the short version of the chart, which is the drop back down to where it started. So on average you might see 25% of the chart excelling up and 75% of the chart dropping back down. This is why the shorters do get to make more money than the bulls. Now 90% of traders fail, just like 90% of startups fail. CEOs that run these companies are exceptional salespeople. They didn't get to become CEO without having the sales ability. These people know how to construct and present a sales package that can entice people to come and buy and hodl. This is their job, to sell and manage the whole company at the same time. Without the sales, without selling, there can be no company. So every CEO is an exceptional salesperson. Everybody is a salesperson, to be honest. We all sold ourselves to meet our partner. We sold ourselves to get a job. We sold ourselves to do a lot of things. We are naturally salespeople. Now, the propaganda these CEOs preach is to embed bullish mentality. That's all they want. They want to lock you in and make you buy their product so they can have plenty of fuel to push the price up as well. Because pushing a price up is a combined effort. Now, whilst we are on the subject of propaganda, let me explain to you what the news and media channels often do. They usually preach the opposite propaganda to what the market will actually do. As you can see in this tweet on the left, CNBC tweeted a head and shoulders pattern asking what happens next. And what did happen next, if you look at this 5-minute candle chart, in the next 10 minutes, we started our parabolic advance. Whilst they were claiming to the market perhaps a short would be the right trade. About 4 hours later, Bitcoin advanced to the mid-sevens, and this morning it peaked, temporarily peaked at $8,300. Now if we were to rely on this as a call and go short, we would have either got stopped out, or those without any risk management would have got liquidated. So this happens quite frequently. Doesn't matter what you're trading. If you're trading oil or commodities, they will preach the wrong trend immediately, and the general public will possibly follow and get wrecked in the process as well. The more people get wrecked, the more they want to learn something, ironically. So the media is all about claiming retention, keeping these people hopeful, and feeding them the wrong information. The market is divided into 4 general sectors. We have the large, the mid-cap, the small cap, and the micro cap. I've highlighted the small cap for two particular reasons. The first reason is most of us end up here simply because the pumps are more spectacular than the mid and the large cap. Another reason is because the small cap is specifically for speculation sector, meaning these people don't even make a profit at this stage. These companies are just stories. And crypto falls right into this sector right here, the small cap sector. Reason why is because crypto is still in the speculative sector. Now once it does advance to the mid and large caps, then we will see more stability with these prices. And we don't want the stability right now. We want this massive parabolic advances and massive drops. So let's begin with the large caps. Large caps are generally established companies that are making profit. They don't always make profit, but they make some sort of income. Now, institutional money is invested here simply because this is the safest place of the market. The pumps are small in comparison to other caps, roughly between 1 and 10%. It is a much safer place to trade. There is plenty of liquidity, meaning if you have to dump and get out, you can, and you won't affect the price too much. Dividends are calculated annually and paid quarterly. Now most countries have an index, either a top 20, top 100, top 50, top 200, 500, whatever. What that means is the top 20 companies, we can invest in them instead of looking and researching individually the best companies in the top 20. So they will run an index and the price will escalate or fall depending on the performance of these 20 companies. The mid-cap. Sophisticated investors usually invest here. High-end brokers also trawl these stocks. Now these are established companies that are making revenue, not necessarily profit, or they are creating legitimate contracts. Pumps here can vary between 1 and 30%. These are the startup survivors. So they've survived the first 2 years. Future stars can also be found in this sector. Small caps. The small caps is pure speculation sector. These companies are nothing but a story at this stage. They have no income and survive purely on CRs, what we refer to as capital raises. Low-end brokers usually lurk here. Their buying power is under 5 million, and they receive free stock to promote and release shares. The biggest pump and dumps happen in this sector, ranging between 10 and 150%. Most all retail investors, traders are attracted to this sector simply because of the pump. Now the pumps don't always reach this high. The general monthly pump would range between 10 and 50%. Once a month you might get a 150% pump, or once every 2 months. Now 90% of these companies will never make a profit, not even $1 profit. Now crypto falls right into this sector. Simply it is pure speculation, and there is not one crypto company making a profit at this stage. So the longer it stays here, the more parabolic advances and drops we will see. But as soon as it does advance into the mid and the large cap sector, we will start to see more stable prices. But we don't want that. We want it to remain here for the next few years. Now after the small cap we have micro cap. This is the most deadly place to trade. Usually under 1 cent, ranging between 1/10 of a cent to 1/2 a cent. Many wrecked hopeful traders end up in this sector after losing 90% of their money. This is the hardest place to make a profit. Pumps are extremely rare but can be parabolic. Liquidity is very low. Most people get stuck into a hodl. Shares are often diluted for CRs, capital raises. Billions and billions of shares are issued with constant dilution. Let's have a look at the evolution of a trader through my mind. Now we all start off as a hodler. We buy something and we hodl it. We read a beautiful presentation and we believe that company is going to succeed. Some of us get in at a stage where the trade is still profitable, but we hold on to it too long without taking profit and end up watching the parabolic advance drop back down. This forces us to come out on social media and start pumping. We want to tell people about it. Hell, we're stuck in it. We believe it's good. Why don't we just drag a few more people into it? This is a natural occurrence. We buy it and then we start pumping it. In some cases, the pumper still doesn't actually sell. He keeps holding or adding to his position. Very wrong thing to do. It gets to a point where the pumper realizes that one day, hell, I need to take some profit. I better start dumping. So he starts to dump and make profit. So he'll buy, he'll pump it, he'll dump it, and take his profit. Once he gets through the swing of it and starts getting used to it and starts to lose his buyers, and doesn't only trade up, then that trader becomes a scalper with no bias. It doesn't matter to him if the price goes up or the price goes down. He can take advantage of it either way. And from then on, the next step is the machine. And the machine is what we are building together. The machine requires several people, lots of data, and we are going to create that machine and bring all our research, all our setups into the one channel. So we know and we have everything ready at our fingertips. And with the proper training, we could take advantage of those setups as we please, depending on our budget. So together, folks, we're building a machine. My job is to take you out of that hodler stage, carry on with your pumps and your dumps, turn you into a scalper, and together we become the machine. So how does the stock market create a community of hodlers? Let's begin with a large cap. The large cap simply offers dividends on their profits. In the mid caps, there's a possibility of earning a profit and the mid cap escalating to become a large cap and one day providing those dividends. Now the mid caps are a lot cheaper than the large caps, and it is a very attractive sector to find the next big pump. The small cap, the most deadly place, or that's where most of us end up anyway. They usually rely on capital raises, CRs. It's usually also followed by options, whether they have purchased a new tenement, which is a block of land, where there might be some sort of previous data, some gold lurking in the grounds, or some lithium, copper, whatever. It might be based on drill samples. This company that has purchased this tenement or got the lease for this tenement may be wanting to drill some holes so they can see the accurate data. How much gold is in that ground? We'll do some drilling. We need money for this. They might also be trying to get into a new sector. Forget about exploration. Forget about minerals. In one company, this company turned from exploring for minerals to the cannabis sector. And their pitch was it was such a funny pitch that they had hodlers believing that they were going to train bees to collect pollen from cannabis plants. They were going to turn this honey into a special honey that can cure people. Now this is what the whole sector is about, remember, speculation. It's all about creating a story. Ironically, that stock pumped, I think about 5 or 7x. Other than that, there's patents. Company will file for a patent, it'll be pending, it'll sound good. A lot of the times these patents will fail, but there'll be a pump. And there's also medical trials where they can be trying to apply for the phase 1. If that passes, then there'll be a pump for the phase 2. If that passes and phase 3 is granted, then you've held on and you've done pretty well, because after phase 3 usually comes approval. But it's very, very hard to get these medical companies to pick them. It's just very hard. This is why we just take the profit through the whole pump stages. We don't care about the end result. We just take profit. Finally, we have the micro cap, same as the small cap. However, there is a CR after CR after CR, which equals to endless dilution, or they'll run some other scam and call it a consolidation. Instead of having 2 billion shares, they'll reduce it to 1 billion, which will pump the price of the share price up, double what it was, because there's half the amount of stock available. So there's lots of tricks that these CEOs do to get your money. Now, traders mainly remain in a favored sector. That could be technology, medical, mining, or commodities, trading currencies, or contracts. Now, looking at the technology, it could be a software that's developing, and you'd have to be acquainted with technology to want to invest in technology. If you have no idea of technology, you've got no reason to be there. Now, all these, the top four, they require much more learning as opposed to the bottom two. Now let's look at the commodities for a second, and let's look at the explorers. These are companies that go out and look for copper, zinc, lithium, gold, whatever. Let's focus on the gold just for a moment. Now, if you want to be a trader that trades gold or gold stocks, then you have to be acquainted with drilling samples and what is a good drilling strike to an average drilling strike to a subpar drilling strike. So you have to understand what is good data that comes out of the ground. Now, to learn that can take quite some time. It could take months. There's lots of reading involved. Same thing for lithium. You can't just jump from gold to lithium. You have to understand what is a good strike, an average strike, a medium strike, or a subpar strike. Zinc, copper, all the same. So the trader will remain to his favored sector. A goldie would constantly look for gold. Lithium, they will go for lithium stocks. Now, these top four induce hodling because they are related mainly to stocks, and they all relate to a story. They all have ample reading involved if you want to see where the company is at with their quest. Now, the bottom two, currencies, CFDs, there's no hodl mentality. It doesn't really matter which way it goes because we are going long or short. We don't actually own anything until we close that trade. And this is where we can access margin. Any time of the day, anybody can access margin. So this is why it is a more attractive sector for us to trade and to learn to trade, simply because we don't have the hodl mentality embedded into our minds, and also because we can offer, or we can get margin through our trades. Now, margin is very deadly. The greed demon can take over and make you go higher than you should go for a particular trade. So the hardest thing to actually tame is your greed demon when it comes to trading these currencies and CFDs. Now let's look at the generic market cycle, which is purely the pump and dump cycle. Now every market, regardless what you're trading, has a pump and has a dump. Generally you will find that the pump will reach some sort of peak, and generally the dump will happen almost or sometimes exactly where it started. So whether that's the monthly, weekly, daily, hourly, 5-minute or 1-minute candle. If you see something pump on the 1-minute candle really fast, it's going to come down almost to where it started, or even lower in some cases. So this is the basic cycle. The reason for this is to trap people above. The more people trapped up here, the more profitable for the buyers down here. They will eventually be forced to sell theirs at a loss, and it gets to a point where they can't handle it anymore, and they just exit the trade. And ironically, sometimes a new pump begins just when they exit. Let's look at how the generic pump cycle is sold to investors. Now, the generic stock pump model works the same regardless, whatever it is. In this case, we're going to look at an exploration company. It's a mock-up. It's not a real company we're talking about, but they all work the same. So these guys are looking for gold. They're not a mining company. They're just a tiny company that goes out, grabs a tenement, lures investors to get some drilling going on, throws in a few options, pulls out the drilling samples, and the price continues to dump. Now this is the story stage. The company's got a new tenement with prior historical data with some decent grades of gold that was drilled in the ground, but it wasn't mined. So they'll anticipate and create a preamble to pump the price for as long as they can, usually 5 days, because they can average a price on the 5 days. So how they sell this to investors is they offer them a discounted stock. So if the price was up here, let's say at about 3 cents, they can say our average price was 2.7 cents. However, if you guys own, for every 2 stocks you guys own, we're going to give you 1 stock at a discounted price of 1.5 cents. Now this is very attractive because the price is close to 3 cents already. So a lot of people come in and try to buy here, when the actual managers of the company and the insiders were buying here, so they can take advantage of the cheaper stocks. They get to buy it cheaper. They already have the stock, and they're not going to take advantage of the CR because they already have plenty of stock. So there's a pump and there's a dump. And then they'll utilize that money that they raise through the CR, the capital raise, and get their drilling permit, which will cause some sort of pump. It'll come back down to a level, and then the drilling will commence. In a lot of cases, the company director will throw in a bit of FUD here. It'll be some sort of lie where they say, we've discovered a brand new vein. Now, this was overlooked through the last drilling sample, and we have found it, but we require a bit more money just to get these extra 2 or 3 holes so we can make sure that we have the good strike. So this will cause another pump. Same as the CR before, but an options pump. Options are just like a share, except it's a lot cheaper than a share, and a date is given. In general, it's roughly 2 years, that by the expiry time, the cheaper option can be converted into a full share for an agreed price. I'll explain more about this later. Now the options get released, causing another huge pump, and before you know it, the drilling samples are pulled out of the ground and presented to the public. Now regardless of the samples, generally there'll be just one final pump or a massive dump on the day. If the samples are great, still not much happens other than a dump. So the company's story ends right here. There's nothing more to preach, to tell. There's nothing more for them to do. Just the hope that they'll get a partner, an actual mining company that will be happy to come over and take over that tenement and start mining the minerals. In many cases, this doesn't even happen. If it does, great. If not, it'll just keep on going down and down and down until they come up with a new story, and that new story will happen when the chart has based. And that base will generally be where it previously pops from. So it'll go all the way up like the pump model and then to the dump model. So there's no point holding all this way. The trader will dump it, dump it, dump it, a little bit more, dump it, and then he'd be out of there and the hodlers will be scratching their head wondering what to do, and they'll start to sell around about here. And then there'll be a new story again, causing a new pump. And that's pretty much the generic pump model. Now it works a little bit different when it comes to crypto coins, but the general concept is the same. They have to embed some sort of hodler mentality for the hodlers, so they can keep buying, keep hodling, keep buying, keep hodling, so they can be trapped up here. They will generally keep adding to their positions, and they will get dumped on in the end. So let's look at the type of traders and investors. There's a fundamental. That's where most of us start. We read something, we like it, we buy it. Then there's the volume traders, people that look for volume scanners. The banks with their platforms, they offer a volume scanner, and a lot of pumps can be seen here. And the novice investor or trader finds the volume spike in the morning, and he goes back to read what the story's about, and he'll make his decision from there. Then we discover the depth, which when I speak about the depth, I'm always referring to the order book. Now the depth shows a lot of secrets. It shows you where the smart money is and where the dumb money is. There's usually so many clues in the depth. I'll teach you guys how to trade the depth as well. It's very important, especially when it comes to scalping. Then there's the day trader. Remember, my view of the day trader is somebody that anticipates a bullish divergence, some sort of run upwards. And then there's the scalpers who don't care if it goes up or if it goes down, because they're going to trade accordingly. If they feel the stock is overpriced, way above what it's worth, they'll start to short it. If they're a chartist, they'll start to short it. They'll know when to start shorting it, when the candles weaken. Now these are the generic traders that are available in the market. These are just normal people like us. And then there's the market makers. Now the market makers, first I'll begin with brokers. Earlier on I explained to you that some brokers receive free stock. So by receiving free stock, they get mainly all the stock that couldn't be sold during an issue. Now they have more stock than the average person. Now these people that hold the most stock in a particular company or on a particular coin, I refer to the chessboard holders. These people can manipulate that stock the way they like. Now during the disclaimer, I mentioned some illegal practices. Now this is where the illegal practices come into it. Now the broker, because he does have free stock, he can dump that to his bids. He can scare all the people out, be waiting down the bottom, make all their stop losses hit, and scoop up all those shares down the bottom, then suddenly put in a huge buy wall and force anticipation and force the price back up. This is referred to as spoofing, and it happens every single day of the week, regardless if it's illegal. Now that's in a stock market level. Now when we look at contracts for difference, derivatives, etc., we look at the FX brokers. The FX brokers, you'll see on the next slide who I'm referring to. But in the crypto stage, we're looking at the exchanges. The market makers here are BitMEX, the market makers for Bitcoin. And also I'm referring to other exchanges like Binance. Now these people have unlimited credit. When you actually put your Bitcoins into an exchange, they're not actually on the exchange. They're kept in a wallet, and you are credited some credits to the value of that Bitcoin on the exchange. Now if you own the exchange, that means you have unlimited credit to be able to push people around. Other than that, because you have the exchange, you have everybody's data at your fingertips. You know when a new bid comes in, when a new sell wall comes in, and you could adjust your trading bots accordingly. Now let's look at the fundamental trader. The fundamental trader on the stock market goes to the Australian Stock Exchange website, and this is the head page. So you've got a few areas here. You've got Market Watch, shows you the generic SPX, all the data, S&P, ASX 200, whatever. The US one will have the SPX. You have the top 5, who's leading the race. This is their version of a volume scanner. Then you have the daily announcements. Now in the stock market on this particular day, I think I counted roughly over 200. Now 200 reports released during the day. So a fundamental trader has to scan all these headlines. And some of these have 12 pages or 60 pages or whatever, hundreds of pages. Some have less. But they have to scan through all these and try to find the most lucrative bit of data on the day, the most attractive data. Now how it used to be in the stock market on Australian Stock Exchange, for some reason they used to cram all these at 9:39. They no longer do it. I complained about it so many times, but you used to get at least maybe 15% of the news crammed into the 9:39 block. Now what a scam this is in itself, because the market opens at 10 o'clock, giving the people 21 minutes to read up and create FOMO and make them have a crazy bid, because who can read all these pages in 21 minutes, right? So the fundamental trader has a lot of work on his hands, but if he's going to jump around like a headless chicken and try to jump on this and jump on that, he's not going to be able to do it simply because he has too much work to do, too much to read. So the way the fundamental trader can win is if he follows that particular stock and follows the balance sheet along the whole way. How much money do they have right now? When will they have to do the CR? So a fundamental trader can win a lot but generally it's at a snail pace. It's at a slower pace. Let's look at the volumes. Now, with the platforms our banks provide here on the stock exchange in Australia, if you look at the left there, you can see the large caps. The middle one is the middle cap. This one is a small cap. Now look at the pumps on the day. The max was 6.5. The max was 8.5. And the max here was 100. Exclude that 1900. That is just a new release. Now these hundreds, and look at the price. They're all in the micro cap sector. So they only have to move 1 pip. This had to move 1 pip to get 100. Now, some fools are going to get lured to this and start buying it because, wow, these can move 100%. They're not really moving. They've got nowhere to go. I remember a few years ago, this one was trading at 0.004. So whoever's still holding on to that is way, way under. Now, these scanners end up on this particular website, which is the banking platform. And you could go through it here, you click the arrow and change to the mid cap. You can go from the advances, most activity, which is volume, the biggest gainers or the biggest losers. So you can filter it out, and it's still very limited data available. And the banks want you to have very limited data and be content with this data and work off this data because they don't want you to win. Because most of the time, like a market maker, they know where all the bids are. And their job is to just short against all this retail money. So if the retails are buying, they're ready to short it. So the bank is not working on your side as far as these trading platforms go. Now a lot of traders learn to trade through the order book. Now I can't go through the order book today, but the order book is basically where the bids are sitting. In this example, you can see there's 60 people that are bidded at 0.02 cents. And here there's 26 people that have bidded at 0.03 cents. Now these figures can be manipulated. Crypto, most exchanges don't show this, but they will in the long run. But these can be manipulated through stocks as well. So this data here, the number 60, there could be one person with 6 bids here and you wouldn't even know about it. Now this is one pump that occurred the other day, Celsius, absolute rubbish company, but it pumped 25% on the day. Looking at that order book, just in general, how I use it is I look for the smallest one here. The smallest one is sitting right over here at 0.25 cents. I'll check the price later on, but this is where many people will be actually coming in to buy it later on because they've put up some sort of wall here. So we look at all the bids and we look for high ones and then a low one standing out. As mentioned, I will explain a lot more. We have to spend a good 20-30 minutes on how to use the order book. But this is how some people trade it as well. You can cross-check the chart as well. If you go and check on this particular chart, at that price level, you will see on the left of the chart some sort of weakness indicating why we should be buying around this level or this level or this. However, this company is total rubbish. Whatever company I'm preaching during my videos, do not buy it. You will get burnt. So please, just remember, everything we buy is rubbish. Now let's look at the day trader. What the day trader would do. They'll stick to the chart and they'll look for their typical long setups. As I mentioned before, everything basically comes off a trend line. As soon as the points are measured from a high point to the next point, etc., there should be some sort of breakout. These red lines I'm indicating are stop losses, where they should be. Some people would put them lower, but I make my stops very tight, because if I'm wrong, I'm wrong. I just get out of there. Just accept it, because the longer you hold on to a loser, the more you'll lose. Now look at the next entry here. It looks decent enough. It's past the trend line and pumped. Got to a point. Another entry, another entry, another entry here, and maybe a possible entry over here as well. So in this time frame, the day trader had 1, 2, 3, 4, 5, maybe 6 opportunities to make money. So let's check out the scalper. The scalper would be going both ways, long and short. So in this case, it may look like that the scalper has overly traded here, but it really isn't, because if this is a period of 8 hours, the scalper wants to utilize his time. So he's going to short, long, short, long, short, long. Another long, short, as we go through. Now remember, I drew this circle on the previous page, showing that there will be another anticipation right here. And ironically, it did pump right there. Later on in the chart, this line was hit over here. This circle was hit just over here. So this dumped way back down here, and the actual entry for a good trade would have been here for a longer trade. And the chart actually pumped way back up close to $5 from this point. So having said that, we could either wait for days for that ultimate entry and do one trade, or if we're going to work an 8-hour or a 10, 12-hour shift, we might as well just take the money, because it's all there anyway. If you take all these trades and rack it up, you have gained so many more percentage points, so many more pips just by remaining active, dumping it. Doesn't matter. No bias. I don't care about this stock. All I care about is what is happening with those candles. And that's all it's about, taking your profit today. Now the market makers. Let's look at the brokerage first on the right. Remember I told you these guys receive free stock or discounted stock. Now they have the name of a broker, so the retail people think, wow, these guys are educated. They do extensive research. They must know a lot. The fact is, these guys get free stock. Sure, they know how to trade. They understand the trend line and what happens after the trend line is breached. But they also manipulate the stock to their advantage. A lot of the times, they will dump it very fast and try to scare people. In some cases, they will pump it to a level and then start to dump it, because the higher you trap people, the more you could shake them out later on. Now also, we have the market makers in the FX, trading contracts, CMC markets. This is a dodgy one, plus 500, IC markets, AxiTrader. Now these offer contracts for difference, and these guys are trading against you, because you're only trading contracts on their platform. This is the same as well, BitMEX. People don't realize. BitMEX is just derivatives, contracts. Your contract against somebody else's contract. And the other person is Arthur, the guy that runs the whole show. So these guys are trading against you the whole time. And a lot of you won't really realize or believe it, but Binance does the exact same thing. These guys have unlimited credit to trade against you. They see all our bids and they adjust their trading accordingly. So there's the market makers. We could ride their wave or we could fall for their trap. Their job is to trap us up higher and flush us out. Our job as scalpers is to understand what these guys are doing and to ride their pump to our advantage. Okay, let's look at the stocks versus crypto. Now, to buy a stock in Australia, your minimum spend is $500 to buy a stock. You cannot buy any less than $500. And the typical fee for that trade would be roughly $10 to $20, depending which banking platform you chose. Now, doing the math, you're already down roughly 3 to 5% when you make a trade in the stock market. A crypto is a lot cheaper. You can make a trade for $5 or $10 in some cases. The fees are much cheaper, from 0.05 to 0.1%. The platforms on the stock market are quite restrictive. All they show is mainly news, the chart is very tiny, and there's not enough trading data available. Now, crypto over the years, there's been lots of developers creating multiple free platforms involving scanners, lots of different scanners, from the chart, from interaction, people talking about the stock or the coin, people creating scanners with calendars and so forth. There's constant building going on crypto, and in stocks there hasn't been much building in the past 10 years. What was available 10 years ago is pretty much available today. There's nothing newer out there to give anyone an edge. Now the charts in the stock market are much slower. It may take months to accumulate before the actual stock reaches the trend line and a pump is anticipated. With crypto, the charts are much faster. A pump could typically be a few minutes, a few hours, a few days, a few weeks. Rarely does a pump last a few months unless we're in the parabolic bull market. So the charts are much faster. The settlement on the stock market takes 2 days. We refer to as a T2 settlement, meaning if you put all your money into a stock, which we never do, but a lot of you do and lose 90%. However, in this example, let's say you put down $5,000 and that was all your money to buy a stock, and you sold that stock the very next day. You could only get the money 2 days after you have closed that trade. So your money is tied up. When it comes to crypto, when we close that trade, we can access those funds immediately and put those funds elsewhere if we find a better setup. In the stock market, we don't have that privilege, so you have to wait. We lose a lot of time. You can't get any leverage unless you have a proven track history when it comes to trading through our banks. In fact, if you want to open up a CFD account, you need a minimum of $50,000 before the bank will let you short. Now, in crypto, anyone can access leverage. And to be fair, in FX, anyone can access leverage too, because they're trading contracts. Now, to do a test of 100 different chart setups, in the stock market, you would need $50,000 based off the minimum entry. If it's $500 for a trade, and you have to do that 100 times, you have to spend $50,000 to be able to test 100 different strategies. In crypto, you can test 100 strategies for $500, or 50 strategies if the minimum entry was $10 for a trade. Now, I know some of you are thinking, well, I'm not going to make money if I'm making a $10 trade. Well, the fact is, if you can't manage a $10 trade, you won't be able to manage a $500 trade. So all my students begin trading small until we can get you guys into the flow of taking profit and understanding that that is all we're here for. We're here to pump it, dump it, claim our profit, and go to sleep comfortably at night. Now, another disadvantage the stock market has is it only operates 30 to 31 hours per week. It opens at 10 a.m. and closes at 4:12 p.m. every day, Monday to Friday, giving us a window of 31 working hours max. Now sure, traders do work beyond. After the close, they inspect all their charts and make their decision on what they're going to do the following day. But realistically, you can only make money 30 hours per week. Now crypto offers us trading 24/7. We can wake up any time of the day and put on our trades. If we're near that trend line, we know what to do. So we could trade any day, any time of the week. There is no restrictions whatsoever. So, the secret to making incredible gains is using OPM, other people's money, which is leverage. Leverage can make or break us. It's very, very hard to tame our greed demon. Now, you can leverage up to 100 times your money when you're trading crypto, and some FX markets as well, but only gamblers do 100x. 25x is max for me. Now if you leverage $100 at 10 times, it gives you the buying power of $1,000, so you can trade with $1,000 just by having $100 in your account. Zero leverage is an extremely slow way to make gains. However, some of my biggest gains were done through zero leverage. I'll show you a few examples shortly. Leverage offers you the option to go long or short, so you're not restricted to just waiting for the price to go up. You can go up and down. Saves you a lot more time. Leverage also encourages us to close the trade and not to hodl, simply because we don't own anything other than the anticipation of that price point reaching a particular price point. We own nothing until we close the trade. When we close the trade, we have realized profits or realized losses. So it forces us to close and not hodl. This is the beauty of trading leverage and trading contracts. Many noobs get liquidated using leverage because the hardest part is taming your greed demon. Now, if we all start trading $1,000, we can't just increase that to $5,000 the next day. We slowly increment up, and once we start making some mistakes, obviously we're not in a comfortable zone, so we have to start reducing our trading amount. Just like if you were to play pool, you will play a lot better if it was for no money. If it was for $20, you might concentrate more and play a little better. But if we increase that game to $5,000 per game for the winner, your hand will start shaking and you will not be as comfortable playing that game of pool. So you won't be able to perform your best. It's the same when it comes to trading. We need to be accustomed or comfortable with a set level that we trade with before we can increment it higher. And once again, once we do make mistakes, we must go lower. The stock market relates to the retail sales cycle. It's pretty much the same thing. A sales scenario, you'd have a CEO, below him a general manager, a national sales manager, a state sales manager, area manager looks after a few stores, then you have a store manager looks after one store, and you have his salespeople. Now all these people work off targets. Once this guy makes his target with this guy gets paid. Once all three make their target, he gets paid. Once again, all these make their target, this guy gets paid, all of them make it, he gets paid, and if everybody makes the target, the CEO also gets paid. This is how it always works in a retail environment. The hardest worker is this guy, but the combined effort is what makes the biggest bonuses, because the group bonuses is what really pays. Now these guys have daily sales targets, weekly, monthly, quarterly, half-yearly, and annual sales targets. Now, how does that relate to the stock market? Okay, we've got the candles. We've got the monthly, we've got the weekly, we've got the daily. So the candle must work in a particular fashion. It has to reach a certain point at the end of the day. Same as the weekly candle, same as the monthly candle. These are all working off targets. Now, I'll explain a little bit more about this in a later video, but the stock market is exactly like the retail sales cycle. It works in the same fashion. Now, the Australian stock market opens at 10 a.m. and closes at 4:12 p.m. The way the system is designed, it's so clunky that the stocks from A to E are available to trade at 10 a.m. and in a few minutes you get the next lot from E to something else, say E to N, and it goes in alphabetical order. So the stocks that start with S, T, U, V, Y, and Z will get released roughly 10 or 12 minutes after 10 a.m. and it'll carry through to the end of the day. So it's only a 6-hour window. The biggest pumps happen on open. As I mentioned before, the news used to be released at 9:39 a.m. and everybody used to run in and pump up whatever they thought was the worthy news on the day. The closing candle is very important, and it determines the course of the chart for the next day or the next week. Now, during the whole session, the last 30 or the last 15 minutes is probably the most important area to look at. What we look at in the last 15 or 30 minutes is the volume action that is coming into play. Now, volume increases in these last few minutes, you know you might be sitting on something that's going to pump the very next day. So the open of the candle is important, and the close of the candle is very, very important. Now, traders can examine the charts at the end of the day and determine what they will do tomorrow with their trades. So they wait. The charts can be delayed. It doesn't have to be on-time charts. Usually it's 20-minute delayed for people that want the free chart access. You don't need a paid prescription to trade these charts. Because at the end of the day, you can make your determination on what you will trade following day. Now my favorite time frames are the monthly. I work down to the weekly, daily, 4-hour, 1-hour, 15-minute, and 5-minute. Now I do trade the 1 minute and the 10-second too, but for different reasons. We'll explain more in a future video as well. Now let's look at my first big win, or my second big non-leveraged trade that was absolutely astronomical. Now, I spent decades in the stock market and I couldn't even do 10% of this. So this particular trade was a coin named Annie, animation coin. Now it's been delisted. Most of these huge pumps always get delisted. I started buying this one at 3 satoshis, and it eventually made its way down to 1 satoshi. And it ended up pumping at a peak of 282 satoshis. Obviously I didn't sell it right up the top here, but through the buying cycle I was able to sell a lot of it in these closed candle areas, some of them in the wicks, but mainly in this region right here. So I was able to dump all that accumulation, which took a good 10 months. Secretly buy, test the people, see if they're catching on to it yet. This is one of my tweets. We've got Annie coin just listed, currently 000189. I claimed I bought the lot, I was buying aggressively, and I kept buying it. And the two major pumps that I can recall, two of my best pumps with non-leverage, is Annie and IOU. Both coins were delisted. This was delisted immediately after the huge pump, and this was delisted recently because of Cryptopia's failure. So this is another non-leverage trade, IOU. Now this was absolutely incredible, this one. I picked it early, and it was going to come down to a set level. It dropped, the lowest it was 8 satoshis. Now it ended up pumping in the first round. It pumped up to about 111, and then it dumped back down to the high 40s. Then it started to create a secondary pump. Now this one reached a maximum of 550 satoshis, coming in from 8, 10, 15, 20 satoshis. As you can see, that is an absolute incredible gain. Again, the stock market could not give this sort of gains to anybody. And I was fortunate enough to be able to find these and take advantage, buy them, dump them, and get out of the trade before they got delisted. Okay, during the IOU pump, I put out a tweet. We're due for a percentage pump to attract the cavalry. Now this percentage pump I'm referring to is a volume pump. When people see this sort of thing, they come in. So this, remember, peaked at about 550, 560. And this was only at the second leg. So the chart had pumped once, come down for the second leg to eventually get up to the mid-5s. So here's a bit more gloating going on, and try to lure in some more people. Remember, when we're pumping, we are selling and we are attracting more people. We're testing the market. We're pumping it and we're dumping some along the way. And here's me boasting about the returns, 5,400% in 2 days, blah blah. Alright, now let's look at the leverage trades. As you can see in the prior examples, those two non-leverage trades were absolutely massive. However, they don't happen very often. They take a long time to get in and start accumulating. As you noticed in one of the examples, it took 10 months to make that sort of gain. Now let's look at Mr. Plebs. Mr. Plebs, I received a message through one of my social media channels, and this guy, I won't tell you the whole story, and I do not want anyone to send me their login details either, because I will not do it for you. But this guy had a story that actually hurt me. It related to my story a little bit. Okay, it was him related to his child and not being able to see his child, and his mind was elsewhere, and the guy got absolutely wrecked. Right? Anyway, I decided to take it on. I put up a post and I asked the public, should I, double this guy's money? And I did. I started trading it. The very next day we were up 125%. That's on the 22nd. On the 23rd we were up about 280%. The same day we were up 331%. And what was it? Four days later we were up to 704%. So this was all done simply through leverage. There's no other way we could have made it, not during non-leveraged trades. Mr. Pleb's campaign ended at 822% in a total of 5 days. So here is a tweet, me talking about exiting the trade or stopping the whole quest, and other people added, oh come on Eddie, keep going, keep going. So I did continue a little bit more until we got to the 822%. And I've concluded here by telling people that the following year that we'll do the thing again. I'll pick out a pleb from the crowd and I'll double his money or triple or 8 times it. So friends, what it comes down to at the end of the day, leverage is the fastest way to make money. Okay, there's no other way you can make these sort of gains in a few days. I've seen people post even better gains than these. I never post my own actual gains because I do not want people to see exactly how much money I'm making. Now, because we're in the crypto field, we are responsible for our own money. We have our own keys. We have this paranoia that someone is going to follow us home. If we lose our computers and we lose the bits of paper that we have our passwords written on, we lose everything. The more you increase your risk, the more chance you've got to make bigger money. However, if you could find the balance of using the right amount of risk and get into a systematic procedure where you're just pumping these pips every single day, you hit your target, you close your shop up, you finish for the day, go to bed at night, you will do well. So, let's have a rundown on the difference between leverage versus non-leverage. Leverage gives you faster gains or faster losses. We don't always win, but if we are wrong, we get out of that trade immediately. We never hold the leverage trade open, never ever. Non-leverage requires an accumulation period, generally months, even in crypto. You want to get a shit coin and you want to buy it without anyone knowing, you have to accumulate it slowly. You cannot push it up. You have to wait, let it all drip into your buys. With leverage, we're using other people's money. So our $1 could be valued at $10 or even up to $25 using 25 leverage, 25x. No leverage, $1 is worth only $1 and will only be worth $1 ever. So you'd have to pick something that's going to pump pretty hard, like in my other two examples of ANI and IOU. 1 for 25 buying power. Leverage pays 24/7, meaning if you look at my Mr. Plebs example, in one day I think I was up about 120%. So in one day 120%, it can pay in 24 hours. But to get that same return, you have to be very precise on your entry in a non-leverage trade. But you can only make it in a few days or a few months. Right? There's no accumulation needed when you're trading leverage. When I typically trade Bitcoin, I'm only trying to grab a $35 to $80 run. That's it. That's all I want. My whole day ends as soon as I've claimed 88 pips. So if Bitcoin has moved $88, that's it for my day. I don't have to work anymore to hit my target. Sure, of course I work more, but I don't have to. I don't have to get those 88 pips anyway, but if I don't have some sort of goal, I'll never get anywhere. So I have that minimum 88 pips. Every single day of the week, I must make 88 pips for me and my clients. No leverage requires a lot more planning. You have to read more. You have to find out when the news is coming. Of course, the trend lines, using your chart helps as well. But you do have to read up a bit as well if you want to gain or if you want to claim that coin that's going to pump to the moon. Now, when you're trading leverage, you lose your bullish buyers. You're happy to short. It doesn't matter to you. But when you're going no leverage, you can only go long, right? It's available to anyone. Anyone could do 1 for 1. You get twice the traffic when you go leverage. So you could go up or down. It requires very strict planning. You have to stick to your plan. The minute you veer from your plan, you lose. So you make a plan, you execute your plan, you get in, get out, get paid. Simple as that. No leverage creates bullish bias. Let's say we're trying to accumulate something that does have potential. Now I'm going to say a ticker here, but don't go buying it now because it's probably higher than it should be. I'm going to mention IOTA. Many people don't like this coin. There's a lot of FUD surrounding it. I love it. I buy it, I sell it, right? If I want to plan that trade, I have to plan it accordingly and try to buy it near the base. So that's how IOTA will work for me. I will buy it when I'm ready. I will buy it without telling anyone. That will be my plan. And when I do buy it, it should be near the base. And once I start pumping it is when I'm starting to sell it. And I don't want to get into the bullish bias, right? I don't want to start believing IOTA really is going to be the next big Bitcoin. Okay, leverage is available to everyone. Okay, in the crypto and FX, anyone can access leverage. But there's no point doing your one-for-one if you understand how to trade successfully. So what charting methods will be taught during Edward's training program? Well, the basics, we will cover some trend lines and the time frames, support and resistance, volume, Fibonacci, RSI, stocky, patterns, and how to put it all together. I will basically put together a blueprint for you with checkboxes. You will check those checkboxes, and if everything lines up, you should be able to make that trade successful, provided you do close the trade, take your profit, and get out as well. Now, this basics package that I'm putting together is quite intense. There's a lot there, but it's not hard to learn. The hardest part is the mindset, is dumping, letting go. Okay, we also will have an intermediate. This will be by invite only, simply because the stuff that I will be teaching here is not available on the market. And if I do just let anybody do this, they will go out there and resell it themselves without even actually understanding it properly. So I don't want people to resell my product. This is the things that I've learned in the past 2 decades. So the magic number sequence. The magic number sequence is a method to trade a chart without even looking at a chart, because the candles will stop at specific numbers. Now, if you go and look at your charts, you may be able to find it. So, go and check out your charts, and go and check out if anyone else is able to explain to you what a magic number sequence is. Now, as many people look for supports and resistance, I look at the opposite. I look for weak candles. I teach you my weak candle theory. I also go through gaps, the way traditional gaps are covered, and the way I cover gaps. I have gap arrays, something I've never seen anybody teach. I have a volume catalyst. I've seen very few people talk about a volume catalyst. I also go through the software that I use, the scanners. I also go through the different methods. I go through the methods trading altcoins. My methodology is different to trading Bitcoin, and a methodology to trade oil and commodities. I go through the different ones, and they all require similar but different skill sets, which I teach. I'll go through the mental mindset, which is highly important. The candle setups. What appeals to me the most? Which ones make the most profit? How to plan the trades. How to get in, line everything up, and get out of the trade. Goal setting and goal getting. Remember, I'm a salesperson at heart. I was taught how to sell, and we don't sell without having goals. So I get you trading goals and get you into a systematic flow so you can do your own thing. Now, those that go through the intermediate and want to take it to the final level and see everything I've got, that's when I start to explain everything. And we have to build a lot of trust together before I can divulge and give all this. Now, there's no point me teaching everybody all this if everyone's going to go off, run off and do their own thing. The only way I'm going to teach the intermediate and advanced stuff is once people start working with us through this brokerage. It's very advantageous for you because trading on your own and trading with my clients' money gives you more leverage. And if you could successfully prove that you have learned you can trade with my client's money. So the advanced, we get the trendline secrets, catalyst times, the Fibonacci catalyst, price point catalyst, volume and candle catalyst, the final mental mindset secrets, and we get you into a competitive trading flow. So, welcome to my world of trading. Are you ready to pump with Edward? The first tranche begins next month and will be limited to some select individuals. To keep informed of the latest updates, follow me at Twitter. And for those of you that have liked what you saw today, please share this video, and if you do share it, I will be putting together a 20-minute video to teach you the basics of trading. We will cover the trend line, we will cover the RSI, how to combine those into your trade. We will cover a little bit about the volume, and most importantly, I will show you the power of number 4 and how I use it in my trading. Once you understand the power of 4, you will see that this whole system is designed specifically of set numbers. The power of 4 is the most important part for a beginner to understand, that the chart is already predetermined, the course of the chart is preset, and we all know which way it's going. So folks, share this video, subscribe to my channel, and those that share it, retweet it, will be getting my free full basics trading module in the next couple of weeks, and access to my Discord channel. So thank you for watching, and I hope you've learned a lot today, and see you on the next video. Bye for now.